Hi, welcome everybody. The main reason for this webinar is to discuss about the callers that I have been doing, caller with stocks, and there are other ways to do exactly the same thing, but I'll tell you the advantage of what we are doing right now. I want to talk about. I mean, everybody wants to know what's happening right now with Tesla, so let's look at it for a few minutes. Let's go to daily chart. So if you look at this move, guess what the move is from here to here? At 76 point, it shows right here, the fourth one, I think. That's 76.5%. That's the move we had. And after that move, generally when the move is so steep, there is always a correction. I would expect it to go down to 50% retracement or 61% retracement. That's what I would expect. I mean, this was a little bit more than what happened. I'm sure this is a panic move for some of them who got in late. But look over here, it came down to 61. It opened at 61, went down a little, then it started moving higher. So generally 61% is what most of the cases or the pullbacks happen to for all the webs, for fib retracements. So, I mean, fibs have always been really, I mean, it's hard to predict. I mean, it can happen in so many different. I'll show you certain things right here. Anyway, if we have a pullback, I am expecting either it goes to 198 or it could pull back right here. I mean, we have a huge supply right there. I mean, this has been a support, this has been a support, and these supports are obviously very important. But again, if there is a FOMO, yeah, it will probably go to 198 or so, then it will probably fall back. Or if the market is bad, it could fall back right away. We'll see. I don't know if I talked about this with you guys before, but
So KP, this is
yeah.
Yatin. So
Yep.
I missed in doing your long term call or investment for the Tesla. So we should wait for the this to fall around somewhere and then can think about doing that for this 25
Are you talking about what we did for the long term?
long term, yeah, 2025.
Yeah, I mean, let's see how deep the pullback is gonna be, and then we can probably think about that again.
Okay,
But
yeah.
I'll keep that in mind.
Yeah, because my we were doing a caller also that time, so I do not wanted to have too many things going on into Tesla, so I did not because
Well, it's only if you are managing different accounts. That's my retirement account. So
okay.
most of my long term goes into my retirement account. That's where I do all my long term stuff.
Oh, okay. I got it.
Okay. This is always fascinating. Look at this. So we had first move from here to here and bounced. And this is your first leg, right? And look at where it stopped. So I mean, this is always, I don't know if the algos kick in, but every time this is, whenever this moves to 38% retracement, if you extend it, it always stops at where the low of the move is. And I have seen this happen way too many times in S&P 500 too. But again, I missed this obviously on that day. Uh, on the day when it turned around, there were a lot of, again, this could also be because I go through a lot of stocks every day. I do miss these things. So is this one. Most of the time, these small trend lines, when it cannot move below this, that's generally the end of it. What's important right here is look the low here. Look at the low here, it's 108, and the low here is 104, and it's 100 right here. So I mean, every time it moves down, it cannot move down, cannot have a bigger move lower. That's when you know that it had the steam or the momentum to the downside is waning down. And then this was the day. This was on Friday, so I saw this. I was doing my research. That's when I decided to put in the Tesla trade. And my idea was for this to open somewhere in the middle of the candle. That's what I wanted it to. I'll show you another example of a similar chart.
KP, sorry to interrupt.
Yep.
It looks like there is a lag from your screen display. I'm not sure if it is just me. I do not know what you're pointing at your screen. I see a pencil icon that is showing somewhere in the middle. So what the levels you're showing, it's not like
that could be because I'll tell you. The reason the icon is showing that is because I snap all these drawings to the other one is, I know what you're talking about. Appearance. This it should be better now, is it or not?
Yeah, I think so.
So, but well, I mean that's the tool to snap onto open, close, low, and high. So it's easy when I'm trying to draw these trend lines. I don't know if you don't use that. It's a very good tool. If you say snap your drawings to here, I mean, initially I used to look at what the low of that move is and try to do that. Now I don't have to. I can go and it will snap to the end of it, or you can even snap to the close of it. So anyway, I think it's okay now. So yeah, when the move happened from here to here, it was really fast, but then it came down only $4, which is 4%, I guess, and another 4% here, and this thing moves a lot. So that's one of the ways that the steam to the or the momentum to the downside is waning. And this was I was in puts on this day. I had a little bit of ratio spreads I got out on that day, but I mean this is a nice reversal. And the other one that I wanted to show is and one of the reasons I wanted to get into this one is because now we have the 77% move. I was expecting it would have around 70%. Now let's look at NVIDIA happened much before than what happened with Tesla, right? So this happened in October. So look at that. That's 73% move. Okay, this all happened from October to December. That's exactly what's happening with Tesla right now. But Tesla fell down late, so it's bouncing back late too. And this one fell down first, and it's bouncing back. So I was expecting the next day. I was expecting something like this. Okay, that did not happen. Obviously, it opened higher. It went up. It closed that gap. Let's go back to Tesla. And I always believe when you have something like this, the close of the gap happens a lot more than a lot more frequently than we would expect. So anyway, so I bought some here and I sold puts, 65 puts when it closed the gap, because I knew that either it will go inside or probably this is it. And yeah, I mean there has been a lot of short covering, I have to say. I mean, a gap up from, if you think about the weekly move for Tesla, that's a big candle, even in terms of the number of shares. It did not happen this kind of volume. The green candle, we did not get it since, what is that, 2020 December. So these things generally happen either when there is a FOMO or when there is a huge short covering. Anyways, so as I said, I was expecting this to move just like Nvidia to about 70% or so. I said 165 was where my target was. If we go into a daily chart, look at where this one is. It's around 166. So I thought it would probably come over here, but yeah, it moved up a little bit higher. Then I went to a longer term chart, and I see that we have a huge resistance here. And also, if you look at this channel, let me open it up. So you have 25, 50, and 75. So that's the midpoint. This one is the midpoint. So we have retraced back to half of this channel. This is a huge channel though. So, all right. I'm just trying to explain you how the price action you can, what kind of price action you can read, or what are the nuances that you can read and figure out, whether there is more downside or more upside. All right. So if you guys don't have any questions about this, I'll go back to explaining the collar.
What are you expecting out of this move, right? Like,
I think this is done. I think this is done. My guess is that if there is a lot of momentum tomorrow in the morning, it will probably go to 198. I don't know, 207 would be a stretch, but 198 makes a lot of sense. That's only because we had a weekend. This move happened on a Friday.
Okay.
So not here. Here. So that's about 198. So you had two rejections there too. And you had a support and you broke that. So yeah, 198 is probably the next big one. But in the long-term chart or the weekly chart, there's 179. 83 is a huge resistance, and also you have this midpoint of the channel that's around 175. So give or take 175 and 180. So that's a huge resistance. So if it does not, if it opens higher, I would probably sell my the longs that we have. The pullback I am expecting is to come back and close this gap from here. Let me get rid of this.
Around 150s?
No, 146.50. So it would come back it will probably fill this gap. So the high of the gap is 154.76. So it's 154.76. So basically it will come all the way down to 146.50. So it has to fill this gap.
It's still whatever you're pointing is not like very clear.
Oh, really?
If it is just me, I don't know, maybe others can comment.
No, I think that's what you're saying is right. I think even
No, don't. Okay, so don't follow the pen, follow the cursor, right? So
yeah, I think
especially on toss, right? The pen and the cursor, like they go horizontal, vertical lines.
I think
So
lines.
don't follow the pen. I think
lines we have to follow the lines which is moving, right? Like 150.
yeah, exactly. So KP is pointing to the lines, and KP, I don't know if you want to expand or zoom in the chart a little bit. I think it's a little small. So, but I know what you're pointing to, KP.
Yeah, if definitely if you follow the
Is
pen is going somewhere else, but you have to see the lines around 140, 150.
Okay. I have no idea what you guys are talking about, but I can see what you're saying, but anyway, my guess is it is going to come back to 146, but it could come back all the way down to 125. You have a lot of support here. See, what happens is whenever you have this kind of move, really big moves, you don't have a lot of volume here. Okay. So whenever you have volume like this, time and volume, that's where you have a lot of support. because there are a lot of buyers and sellers here, and eventually buyers win and it breaks out. This is one of the reasons I buy many breakouts, because whenever there is a congestion or consolidation, if it goes lower, sellers win. If it goes by higher, buyers win. That's how the more the congestion, the higher the move is gonna be. So anyway, my point about this is actually, yeah, what I wanted to show is what happens if it goes all the way here. Let's check this out. So no, that's not it. That's 218. 218. If it goes to 218, then it could come all the way down to 146. If it does only 50% retracement, then it goes to 191. Yeah, can you see the fib lines?
Yes.
Okay.
No.
Okay. All right. So yeah, we'll see what happens tomorrow. But NVIDIA was perfect. I mean, you had a support here, it came back here, and look at the kind of retracement it did. It was a 61% retracement. It came all the way down to 61%, consolidated and break. But again, here you have this support, and also you have the 61% retracement support. So when you have multiple supports, a lot of people are watching either this one or this one. So more supports is always better. The same way right now for Tesla, you have two resistances. One is the trend line, and the other one is the long-term price line.
So it's in uptrend right now, KP?
It is, but I'll tell you what, I don't want to buy ever when something went up. 22% in 5 days, 6 days. Okay. You would want to wait for a consolidation like this. And
Yeah.
if it breaks out of that consolidation, that's when you get in. And a consolidation like this is amazing, because let's say if you buy it open, that's only 8% loss. So as long as you keep it to single digit, your stop losses, you're going to be fine.
So actually, I was asking because I have some holdings and I'm almost at the no profit, no loss. So I'm just thinking, should I keep it hold, or like it is a good idea to exit?
I don't know how to answer those questions, man. but I mean, look at this. This week is going to be very crucial. Okay. One of the things I always do when I don't know what to do with a position is trim.
Okay.
That is the easiest thing we can do. Okay. Reduce the risk. If you don't know whether you want to stay in or not, and if you're in break even, the best thing to do is trim. If it's break even, trim 2/3. Keep 1/3 and see what happens.
Okay.
And if it breaks below, what is that, 188, get out. That's it.
Okay, I got it.
And okay, talking about this one, we have, yeah, it's probably going to 208. What's this? That's exactly where it went to 206. Yeah. So yeah,
NVIDIA is not a breakout.
Say that again.
Is it not like a cup, and is it not breaking out? Can we not interpret it that way?
Well, this is inverse head and shoulders for sure. See, that's your first shoulder, head, and this one. But the only thing is, you would want to see something like this right here.
Yeah, because of the base of
it went straight up, right? I mean, what happens is, if it opens below 193, it's gonna go back to 168 really fast, because you don't have a lot of volume. All these guys will panic and they'll just sell it. Again, one of the reasons I look for consolidation is you have a bunch of people ready to buy in or sell out based on how the consolidation is. You will have both buyers and sellers in these ranges. So whenever it gets out of that range, if it goes down, it's a short. It could, if it goes up, it's a buy.
So when it comes back and consolidates, are you expecting the 168 level? It should come down and consolidate, or can it hover around 190?
Consolidation can happen anywhere, right? I mean, again, if it's coming down, there is no trade for us. Okay, we will get into the trade again when it goes back about 191 for the upside, at least. Yeah. All right. If you guys don't have any questions about, I know these are the biggest ones that we have, the FSLR, right? I can talk about FSLR. Well, one of the things I am a little concerned about is selling these 115s. I know, I mean, this is a huge volatile stock. If market goes down big time, then this will be in trouble. I mean, we can always move it down, but we will have to pay up a little. That's the only concern. And because these are really big trades, I'm a little concerned, that's it. But according to the chart, the move to, whatever, 200 makes more sense than anything else. This should happen really fast. And I love the way, it came down, it's consolidating a little, and now it started breaking out. And look at what happened at the end of day on in SPY on Friday. This is really encouraging. I don't know how much time do you guys spend on price action, but you had a big move down here for SPY. Let's do SPX. I don't know if it had yeah. Look at how much move you had on SPY or SPX, and look at what happened to First Solar. It barely came down. So this is strong. This is really strong right now. Probably one of the strongest stocks I like. And in all these big trades that I'm taking are the best one I can find in the market. Same with PDD. I think PDD will. For PDD, I think it's more risks to the upside than downside right now. I think this 140 will happen very fast. That's what I'm expecting. Really fast. The best thing that could happen for us for PDD is it goes down and then comes back up. If it goes down, we can reduce some of it, or all we have to do is just wait, let that premium get decayed, and then if it goes up, we are good. But things rarely happen the way we want. And look at, I mean, the pullbacks are really small. Look at this candle and look at these three candles. Whenever there is a pullback, the candles are really small. Whenever the move higher happens, look at this one. Big candle, big volume. This is the smallest volume ever. And look at how low the pullback is. The same. And most of the time in a bull market, this is what I'm looking for. It goes down not for 3 weeks, but 3 or 4 days, but smaller moves down with lower volume. And then all of this is taken out on a single day. If this was a daily chart, that is what I'm looking for. Of course, this is a weekly chart. I mean, if you look at the Hang Seng chart, I don't have the Hong Kong chart, but the index, it's at a resistance right now. But this one is the best in most of the Chinese stocks that we look into. All right. Let me go to. All right. This is what I wanted to talk about. Why are we buying these huge thing always comes in the middle. Okay. So actually let me get rid of that. Let's look at something. Okay. The reason that we are, I don't know how many people understood when I mentioned about the risk-free rate that we had in the options. So what I mean by that is, let's look at February, right? So 104.68. Let's look at 105. Look at the 105 put versus 105 call. They are identical. Okay. this is how it has been for many years for most of the stocks. Okay, if you look at the what is that formula? I forgot what the formula is. Anyway, so these options, when they go out, they include the risk-free rate. What that means is that if you buy a call, buy a put and sell a call and buy the stock, when you have stock, generally a lot of people buy callers so that you're not losing or you're not making any money. Okay, but by doing that, what happens is, if you, let's say, if you had 1,000 stocks of PDD, okay, let's say it's even your well, what are those called? The employee paid, employer paid stocks or whatever. For them, you buy this, you sell this, and if you have the stock, what happens is, you could do this 2 years away, and you will not lose money at all. So if the stock moves higher, okay, by the end of it, this is going to go to zero, and because you sold this call, they are going to get your stock. If it goes lower or closes anywhere below 105, whoever because this is your insurance, whomever you bought the put from, they are going to get the stock. So you will have nothing. But because we have this risk-free interest rate, we have this huge difference. So the 20 and 24. So if we do buy a caller, I'm going to also show you the alternate for this one. Caller with the stock, right? So this costs about $100.83, right? But what is the worst case scenario for this? Okay, either if the stock goes down, well, I mean, there is no worst case scenario. If the stock goes down, you will sell it for 105 to whoever you bought the puts from. If it goes higher, these guys will get your stock, right? But your cost is $100 and you are making 105. The reason you are making that $4, whatever, $4.20 is exactly what the risk-free rate is for 1 year, for 365 days. You put it in a bond for 365 days, you're going to make this money, the $4. That's your 4%. Okay. So when you are doing this, so you can either do this or you can go ahead. This is what, $20, right? You can go ahead and sell these calls, 115. What I'm trying to do is whatever I'm spending here, I'm collecting it right here. This is another way. So here you are spending that $4 or 4%, whatever you are supposed to get. And let's go here and see. Because you are spending that $4,000, you'll probably make $10,000. So you are foregoing your interest that you would get and make $10,000 instead of $4,000. That's one of the reasons why I am doing this, because we have an extra 4,000. So we are using that 4,000, and now if we buy 140, or I mean, if you sell the 140 calls, right? Your cost is 112 right now. I mean, for us, we did the 100 caller, or bought the 100 puts and sold 140, and our cost was 109. But here, because it went up another $4, now it costs about $112. And the maximum profit you make is either 27. You lose 7,000. So for risking 7,000, you are making 27,000, which is a very good risk reward for me. And this is one of the reasons I'm doing a much bigger trades. And even though we are spending 20% of our portfolio, our downside is about, most of the trades that we did is about 2% of my portfolio, and upside is is triple of whatever my loss would be. So this made much more sense than anything else. But right now, okay, I want to also talk about what if you don't have enough money and you don't have this, this kind of, you don't want to invest this kind of money, then you would have to pay up for those 4%. What I mean by that is, when you do a covered call, right? Forget about this leg. Let's talk about just this leg. Buy covered stock. So what you're doing is you're buying stock and you are selling the call. Okay. And this is costing you $92. The maximum you will make is $140. And you have all this to the downside, obviously. So your cost is 92 and the maximum money you will make is 40 plus 8, $48. Okay. So this trade is exactly the same as, let me do blast all, as
So how much money would you need for this trade, KP?
well, that the whole collar and everything.
No, I mean to say the one you are saying, the alternate option. Caller, I understood. The other one you are
I mean, there isn't much. That's what. Let me explain. So, no, actually, you don't have to put any money at all. Let's see how much this would come out to. So, this covered call is same as it's selling a synthetic put. What that means is you are actually selling 140. You are selling 140 put, and you are making $41 on each of them. You are taking that money out. So did you guys understand what I said? So this covered call is same as selling this put.
Yes, yeah, I got it.
Okay.
You would need
So
money, right? I mean to say, let's say for 10,000 or 1,000 stock, you would need, if you're selling a put, naked put, right?
yeah, but we are not selling naked put, right? I mean, that's what this is just one part. Okay. So now let's compare this with the collar that we have. The collar would be, instead of doing the collar, you can just do sell a vertical, and that would be 140 and 105. So this is what you would get. So let's get rid of that.
Yeah, can you remove the old ones?
Yeah. Let's do this again. Sell a vertical 140 and 100. So you get a $24.90 credit for a $40 spread. Okay. So you would be losing what, $15 or something. So you lose $15.10 on each one. So that's $1,500 for each contract. So your margin would be that $1,500 for each of them. But you do have to understand that because you are only doing this, you are losing the advantage of that risk-free rate that I was talking about. That's the only reason why I'm doing those collars,
Yeah.
Does that make sense?
Yeah, but on the collar, KP, let's say if you can just go back to the collar.
Okay. I'm selling 140.
So in this one, let's say by 19 January, it is not reaching to 140 and neither it is going to 100. It is just lying, let's say 130 it is.
Yep.
So we would be owning the stocks, right, in that case? So
No, you weren't. So let's say if it closes at 130, That's
Okay.
actually a very good scenario. How? This is how it is.
Mhm.
Because you have these puts,
Mhm.
because you bought these puts, the guy who sold you these puts
Mhm.
will own your stock. I'm sorry, I'm wrong. I'm wrong.
Not right.
That's big if it goes below 100. Anyway,
Below
so
100.
yeah, you will end up with the stock.
Yeah, and
No,
then
you are owning the stock anyway. Yeah.
yeah, then you that means the basically you'll get 3,500
Yes.
for each
And
100 unit.
hold on, 109 minus 130, right?
Yeah, and see if you do
20 bucks. Yeah,
yeah,
20 bucks. Yeah.
20. Yeah, yeah. Okay. Yeah. Okay.
But this goes to zero and this goes to zero. Actually, that's not believe me, it's not gonna stay in this one. Either goes down a lot or it goes up a lot. We
Yeah.
will have to definitely adjust it. The one good thing about these trades is that if this starts to, let's see, let's go back to PDD, right? If it goes down below 95, then we would have to, move this lower and make some money. So how much are we risking right now? We are risking about $9.63, right? We will have to, either move this lower and, make $5 or $6 and probably, either stick with that or we can still go short term and sell, 120 or 125. I don't know if this will have a lot of value by then or not, but you can always sell these spreads against your whole position. I mean, there are many ways to adjust this trade because you have that extra $4.
Yeah.
But
yeah, margin you would need it. Yeah, somebody wants.
yes.
Yeah, I see that.
Okay.
Right?
Let me tell you something else. Well, I mean, this I found out recently. I spoke to my guy at TD, and he said, "Where is that thing? Did I get rid of it? Oh no, this is on the list." Okay. So I would have to, yeah, these two. SW, can you guys see this? SWVXX.
Yeah.
So SWVXX and the SNAXX. The SNAXX is for anybody who wants to invest more than $1 million, and less than $1 million is SWVXX. Let me go back and let me show you what they are. It doesn't show any here. So anyway, I mean, you guys can go do the research, but these are money market funds. This is only available for TD because these are Schwab money market funds. But you can put in today and you can take it off tomorrow. I mean, you can get in and get out anytime you want. So what they do in these funds is they are going to invest your money into money market funds, and they take a small fee. I think it's around 0.15% of per year. I think that's their fee, which is not bad when you're making 4.27% per year. So whatever you have, you can always put whatever is left in my 401ks or my retirement accounts, I just put it in the SWVXX. It pays about 4.27% right now. I mean, as long as the market, does not turn around, I think I'm going to stick with this. I mean, we could have done this last year. I didn't know about it. So yeah, go ahead.
KP, this
Yep.
is the well. Hey, so
Yep.
this is interesting. One of my guy at TD told me about those CDs that TD Ameritrade has, but
Yeah.
I think this is more liquid, so you can sell it
It is.
anytime, right?
It is. This is not a CD at all. This is not
Yeah,
a CD at all.
because
Look
that
at
CD is also your. Okay, help me understand this. So when you need more margin, or does this the money parked in this money market instrument, does it count towards your cash available towards margin or no?
it does. It does.
Oh, it does. So you don't have to physically then take it out, right?
Repeat that.
If you know, okay. So let's say if things go south and you need more margin, basically under your portfolio margin account, right?
Yeah.
If you need more margin,
Yeah.
does the money parked in this money market instrument
do they count towards that? Do that cash count towards your overall account value?
I don't think so. I don't think so. I mean, you
So you
will
have then
have to-
physically take it out and put it in the
Yes.
trading account, right?
Yeah, yeah, yeah.
Okay.
I mean,
okay.
it's actually buying and selling. I mean, taking out means you're selling it.
Yeah, no, I
Yeah,
got,
yeah,
I
yeah.
got that part. But
Yes,
it's
yes.
just sometimes, yeah. I mean, when I had the T margin account, I used to get this margin calls, and you have to dump more money to
That's right,
either
that's
meet
right.
the margin call or close the
That's right.
positions, right? Yeah.
That's right. And because we are still, you know, we are still have a lot of cash. This is probably and for those big positions, we still have our downside. It's not like we are losing a lot of money. We are not. That's
Yeah.
for sure.
I mean, it doesn't
So-
require a lot of margin in portfolio
Yes.
margin. It's like very small margin that requires.
Yep. So yeah, these have been good. The reason I'm talking about this is because the trade that we are talking about, the PDD, let's go back there. So when you sell, I mean, this is something I learned about this a long time ago, but I never used it because we never got any you know, a high money market interest. So let's say if you are doing this trade, let's say 100, okay, you are making $24 here, right? So your maximum loss is 15,000, it says here, right? So if you take this trade, you can go ahead and this credit, whatever you are getting, 24,900, you can go ahead and put these 24,900 in that SWVXX. 24,900 into 0.0427. So you get $1,000 in interest during this period. So yes,
Yep. I got your point. Yeah.
so your loss is not really just 24,900. You will save $1,000 here. So I mean, that's why this is one of the things like this book called Options. I think Options Trading. What is it called? The Hidden. I'm gonna send you the.
Yeah, send the book name as well. I think this is. So I didn't know about this instrument. I actually took out a big chunk of cash and put it in some of those like no penalty CDs, and even through TD, I logged into like some of the, even for 3 months. But I think that's still logged in, right? This is
it is.
This is good.
Yeah. So the Options Trading, the Hidden Reality, it's by Charles Cottle. I'll send you the book. If you want to know, I mean, this book is extremely complicated. It takes a while. But if you spend time on it, he tells you a lot of things like this. And then this book was written a long time ago. So he talks about, you know, instead of whenever you are buying a call spread, right? Instead of buying 140 call spread, right? You sell 140, 100 put spread. Okay. It's the same thing. Okay. But this money you can, whatever the cash you have, I mean, right now they pay only 0.35%. If you are an Interactive Brokers, right, they pay 3.8% or whatever on your cash. So you sell anything, you are trading, and while this cash stays in your account, they'll pay interest on it. I know it may not be a lot, but you know,
But it accumulates.
It pays for something.
TD doesn't pay, right?
TD is 0.35%. It's very less. Yeah.
Unless this is SWVXX or SNXX.
This will help. Yep.
Okay.
Yep.
All right.
All right. Well, this is all I wanted to discuss. And if you guys have any questions, we can talk about that.
KP, with the scholar approach, right? Say, for example, if PDD were to move to $138 next week, right?
Yeah.
So other than the adjustments and like whatever that risk-free rate, what you obtain, would we take advantage of that?
So the first thing I would do, okay, if this goes up to, I mean, that's what we did for Tesla, right? When it started moving higher, we started moving our puts higher. We rolled them higher. Okay, you would still have to pay up a little. So what I mean by that is, let's say, let's see how much is $15 worth right here. This is 19 and 90, right? 90 and 105 is 19. That's about $8. So for $15, if you are moving a put from 90 to 105, you are paying up about $8. Is it $8? Yeah, $8 for $15. Right? That's a lot actually. Should be less than $7. Hold on. By a vertical. Of course, this also depends on how much what the volatility is, but okay, 755, that's fine. So so to move a $90 put to 105, you would end up paying 750 and you're making 750. So the same way, if the stock goes to 130, you can always move this to 130. You will end up spending about $15, but your downside has decreased by $15. Does that make sense?
No, I lost you somewhere.
Okay.
in the
No,
result.
so
From
what
90
I'm
to
trying to figure out is right now, right? If you we have 100 puts.
Exactly. We have 100 and 140, right?
Yes. So let's just pay attention just at the put side, right? So if this goes to 100 and let's say 130. So now this is costing about $17 to buy them, right?
Mhm.
But if this thing goes to 130, okay, this will go below $15, half of the spread. Generally, it goes half of the spread. So when you buy this, right?
Mhm.
So when you buy this, your downside is now not 100. Okay, your downside is 130,
Mhm.
but you're paying an extra $15, right? So
Mhm.
your cost has gone up from 109 to 124.
Mhm.
So your cost is 124. Okay. Your downside is 130. It means that you put in $6 in your pocket already.
Mhm. Mhm.
Now, if you want to use that $6, you can use that $6 and move your 140 to 150 or 160, whatever that pays you.
Mhm.
Okay. If you do that, now that's a risk-free trade. And you have a upside of another. Let's say if you can move it to 150. I don't know if you can, yeah, you can easily move it to 160, 150, because you will probably pay less than, you'll probably pay about $4 for $10 spread. Do you understand what I'm talking about?
Yeah, I'm understanding the rolling part of the things, right?
Okay,
That
so
we
here you
the
have,
stock.
so you have made $6 by rolling this, right? So now you can use that $6 and roll the call up.
Yep. Uh-huh. So you
And
said
you
higher
can,
call, buy the
So it's
one.
basically you're still continue to pocket some money
yeah,
and have your skin in the game
yeah,
and have your downside protected. That's what he's
yeah.
trying to say. Maybe I don't know if that makes
It
sense.
is. The thing is, once I mean, see, for our Tesla trade, the reason I got out is because we made good money and I don't have to be in the trade for a long time and lose whatever I made. Okay. And then earnings is something I never get to be involved in. But if we really wanted to take the risk, we could have just stayed with what we have with that 135 put because we did not have any downside. And we could have, but we would have lost our profit. This is also the same way. Once we make a little bit of profit, our first job is to protect our capital. Okay. We roll it down to 130. Okay. We not only protect our capital, we have $6 extra that we can use to buy something else or, roll your call or whatever. So that way you can do it for a very, very long time. As long as the stock goes up, you keep moving this one and that one, this one and that one. But it is so much easier for you to understand when you are doing a vertical. vertical like this.
Mhm.
Let's say you have this 140, 100 vertical, right? What would you do when the stock goes up? All you have to do is move these puts up on a regular basis. And that's it. That's all you have to do. Every time you move it up, you're pocketing a little bit of money.
So KP, how are you saying you are pocketing up your little bit money? Because we are paying more, right? When you are moving up the put.
No, how much are you paying? That's the question, right? From 100 to 105, okay? You are reducing your risk by $5.
Risk reduce, I totally understand. Yeah, we are
Yeah,
definitely.
we are reducing $5 of risk, but we are paying $250.
Okay.
So once you whatever cost you are putting in, once you get your cost back, and every time you roll, you are actually making money.
Yeah, but if that put becomes worthless, like when the price doesn't meet, right? So then you are.
No, the only reason we are doing this is because they are so far away. These are never going to go worthless for another 6 months. It doesn't matter where the stock is going.
Oh, okay.
Okay. This, because it is so 1 year away, it's very hard. Look at this one. The price is 105. $40 is still $1.52, which is, it has to fall 60% to go there.
Okay.
So, I mean, these are not going, I mean, unless you have 50, 60, 70% move. Yeah, nothing is happening. I mean, they are not at least going to zero.
No,
Yeah,
okay.
these are time-bound derivatives.
Oh yeah.
So there is a long. There are more moving pieces.
I mean, if you were doing this in probably February or in March, you would probably just sell it and go buy something else at a later date. And the reason, and because we are doing 20% of our portfolio into a single trade, it makes sense to just sit with it and roll them on a regular basis.
So we are just selecting the stocks which has more, uptrend or the profitability.
Of course, they have to be. I mean, these are the best stocks in the market.
Okay.
These are the best stocks. I mean, PDD Tesla was not the best stock, but the only reason we got into Tesla is because it went down. I mean, I was actually my friends, they asked me, when to get in Tesla. I said, I don't know what kind of, I can't remember I got rid of all those levels. I think 120s is when they actually bought them. I think it could be this one. This one. Yeah.
Yeah, so I was just thinking in the same line. Then why not to do these collars with Amazon or Google?
The reason. Okay. First thing, the reason we are doing this whole collar thing is because if this was a bull market, I wouldn't even think about that. Okay. There is a huge risk to the downside still. Okay. We have not done anything substantial to say that this bear market is over. Okay. We are getting, what do we have right now? I mean, this is the simplistic way of looking at the charts. Lower high, lower high, lower high, lower high, lower low, the same way. Forget about the lower lows. I mean, if you're getting lower high, that's in a downtrend, that's it. So I keep saying this 4100 is important because if it breaks higher, that is the first time in over a year that we are seeing the downtrend, to be breaking out. First time in a year. And we have been in cash for what 14 months now. I mean, I'm going crazy. I never did this before. But, preserving his capital is obviously very important. And the stocks that I buy are the ones that, goes to new highs and breaks out, like, what is that? What do we have? LTH. This one, these are the stocks that we should be looking into. These should break out and move higher. I mean, some of them that I'm tracking. This looks like a bullish chart. Absolutely a bullish chart. Show this to anybody and they would say we are in a bull market. But some of the stock, these are when the market turns around, these will fly really, really high, but they are not. I mean, we are still not seeing institutions get in and buy any of these. I mean, but unless that changes, that we see a lot of institutions come back and buy these. Look at this. This is based on a drug. We would not see this in a bull market. You wouldn't even get a chance to get in. It will go consolidate for a day, for a few days, and then it will bust up open, and it will go much higher. In a bull market, you will see many stocks that you miss. I can count. There are probably 10 stocks that I missed, in the last 1 year. That's it. And then last year, ENPH was doing amazingly well. Look at what happened. It's crazy. And I thought this would be a leader. I didn't think First Solar would be a leader, but they are in the same industry. Look at how First Solar is doing, how everything else is doing. So the good thing about following the trend is, you will limit your losses. All right. Well,
So KP, with the Scholar trade, ultimately you had protected your Tesla downside or PDD downside, right? So
Yep.
that is what the caller has ultimately given us. Right?
Yep.
But in this Tesla case, for example, right, whatever that 50%, 60% move it had,
Yep.
had you just had the stocks compared to the Scholar,
Yep.
what would be the relative difference? I did not participate in the Scholar trade, so I am not able to gauge it. What is the relative difference in the gains, right? Had you just gone purely on stocks, it's understandable.
I wouldn't have. The reason is I need that protection. The
Yeah.
only thing that we could have done is just buy the put and not sell the calls. Okay, that would have increased our, the cost of our trade. But see, the one thing I would probably never do, because of all my experience in losing earnings, is that I would never participate in an earnings trade without having a big cushion. And in this market, it would be stupid. It would totally be stupid. I mean, believe me, if the earnings were bad, this would have come back to 100 really fast, really, really fast.
Or even could have gone down way too big,
It
right?
would have.
It doesn't.
It would have. I would.
My Amazon example.
Yes. I mean,
I was
the only
34,000 in plus on that
Yeah.
day, and
Yeah.
then it went down 82,000 negative as I
Yeah.
landed in Saint Martin in 2 hours.
Yeah.
It was that bad.
Yeah. Hold on, guys. Give me 1 second. Yeah. So, I mean, see, one of the reasons all the guys who had Tesla for a very long time, they saw this thing go down 48% in, what is that, 25 bars. That's about, a little over a month. 48% from here to here, after they have lost 50%. So this is a flush. This is the kind of flush we should see in the market. And that didn't happen with Apple yet. One thing that my assumption is that because everybody is thinking that there is a recession, it's not coming yet. My assumption is it's going to pull everybody back into the market, just like Tesla did. Then we'll probably see another fall. And then we will see a flush. If we see another flush, which the third leg is always the worst. If we see another big flush, then we can get in. We don't have to worry about, buying these collars anymore. We can just start accumulating some good stocks, and we'll probably start seeing those breakouts. I don't know. I mean, some people are saying 1, 2, and this is 3. This third leg is never like this. Okay, third leg is much bigger. That happens all the time. But the thing is, if you look at what's happening in the world, we are not seeing a lot of, crashes either. I mean, nothing has broken down yet. Maybe it takes a while.
Yeah, or you need an event. breakdown.
Yes, that's exactly what we need. That's exactly what we need. Yeah.